gentlemen, a dividend is a distribution of profits from a corporation to its shareholders and one of the most passive income sources, in my opinion, you can get involved with. And I've been listening to some chatter in the community, and I want to break down some of the stuff people don't fully grasp about dividend stocks. So ladies and gentlemen, I look so forward to breaking this down for you. So let's jump right into this.
Drop it.
Welcome back, my passive income investors. I like the things you gotta know about dividend stocks. I've been listening to chatter in the community, and I found these two very misunderstood things. The first one being is, how do dividends get paid out, and how does the ex-dividend date work? The second being, how are dividends taxed? I'm going to touch base on withholding tax, long-term capital gain tax, share with you some tips and tricks that have saved me thousands of dollars. And in the clarity of my transparency, all I ask from you in return is to simply hit that like button. So ladies, gentlemen, let's get right into this. And I'm going to be using RioCan, which is a real estate investment trust, one of my favorite, as an example, as it's currently paying out a 9% dividend yield. And we're going to go take a look at the payout schedule as it stands. And we just had a declared dividend today, which we can see is the ex-dividend date. Now, the biggest myth surrounding the ex-dividend date is that if you buy it just before, and to give you an example here with RioCan, the ex-dividend date is today. So if you didn't own the stock before today, you're not entitled to the dividend that it is paying out June 5th, which essentially is a week from now. But somehow people think if they buy it a date before the X date, then they get the dividend and sell the stock, they're going to end up being ahead somehow. But this just isn't true. And let me explain to you why. When that ex-dividend date comes, they actually calculate out the removal of the dividends into the stock price. And to give you an example of what I mean, essentially RioCan's paying out a 12-cent dividend. I know there are 317 million shares of RioCan out in the market, which means they're paying out, if I times those two together, they're paying out $38 million in dividends this coming month. Now, if you took that $38 million and you minused it from the market cap going into the ex-dividend date, you should actually see a reflection of the stock price going down. So with that myth, if you're buying it just before the ex-dividend date, yeah, you're going to get the dividend, but you're also likely to see your stock value drop. Now, if you buy it during the ex-dividend date or after, yeah, you're not entitled to that dividend, but chances are you're going to be picking up a few more shares than you would have the day before. And I just really quickly wanted to clarify that because I think too many people fully misunderstand it. So the next thing I want to touch base on is understanding these taxes and how to properly take advantage of them. The first tax, the most misunderstood tax I want to discuss, is what they call withholding tax. And I'm going to use an example out of my TFSA because I only have one stock that experiences this. Now, if you don't know what withholding tax is, under a treaty, a 15% withholding tax generally applies to U.S. dividends if you are a Canadian citizen, same vice versa, but this isn't exactly true. And let me kind of clarify this farther if you want to buy some over-the-border stocks, because in fact, I only have one stock that I pay withholding tax on, and that is GEO Group. You're going to have to do a little bit of research, but they have what are called qualified companies. So if I'm in Canada looking at U.S. stocks, I want to look at U.S. stocks that Canada calls qualified companies. And for example, Apple is a qualified company, BTI, MO, Microsoft, Southern Company. So those companies I don't actually get charged withholding tax on, only GEO Group. And that is because GEO Group is a real estate investment trust. And if you are aware, REITs get taxed a little differently than typical companies. And I can actually show you how this tax applies to my dividends by simply looking at my transaction history of GEO Group. And if we look, we can see my dividends that came in right here, guys. I actually got quite a few dividends from GEO Group. And if we take a look, we can actually see the tax that was withheld from me getting that payment. And it wasn't a whole lot. It was 15%, obviously. So if I get that 10% yield from GEO Group minus out 15% withholding, that means my actual dividend is about 8.5%. Now I'm going to touch base on some tidbit advice about how you can kind of work around this withholding tax. That it's going to save you a stupid amount of money, but I just want to touch base on some of the other tax rates first so I can kind of clarify this a little better when I come back to it. Now, the second thing is, how are, dividends taxed in general? And I'm going to try and clarify this on the US and the Canadian side of the border. But typically, if it's just a regular company like an Apple, Microsoft, or a bank stock, usually that dividend income just gets taxed at your regular income rate. Now, there are benefits depending on where you live, and sometimes those dividends can get taxed at a lesser rate. I advise talking to an accountant or doing some homework on your government websites. But in general, we can see in the US that if you're making $40,000 a year, your general dividend tax rate is 12%. In Ontario, on the Canadian side of the border, essentially $48,000 or less, you're likely to experience about a 15% tax on those those dividends as it is. Now, the last thing I really want to touch base on is the capital gains rate. If I go back here, guys, we can actually see it shows the capital gains rate, or what you're going to be taxed on stocks that don't pay dividends. So let's presume you bought Facebook stock and it rallied and you sold it. You're going to be paying about a 15% capital gains tax. Now, in Canada, it works a little differently. There are some comparisons in the US as well, but if you're holding these companies for longer than a year before you sell them, you'll actually get a tax rate deduction. So let's just presume you put $1,000 in Facebook stock. You hold on to it for a few years. The stock doubles in price and you sell it. You now have $2,000. You have $1,000 of capital gains. Well, because you've held on to it for longer than a year, you're only going to be paying regular income tax on 50% of that. So of that $1,000 that you made, you're only going to be paying tax on $500. Let's just quickly summarize what we went over already, and I want to show you how you use this knowledge to essentially make some extra money. So the first thing we know is you're going to be paying withholding tax on certain companies. You're going to have to do research if you're buying these over the border. The second thing being is you're generally taxed regular income rates on dividends. And the third thing being, if you're holding companies for longer than a year and you experience some capital gains, you're only going to be taxed 50% on that here in Canada. I'm not too sure about the US. But taking that knowledge of dividends, how do we apply it to making some extra income? Well, luckily, the governments in the US and Canada offer us these tax advantaged accounts. In Canada, we have things called the TFSA and the RRSP. In the US, you have Roth IRAs and the 401ks. Now, how I'm personally utilizing these accounts is I try and keep most of my dividend stocks in a tax-free savings account, because in the TFSA, if we go back to this, all of the dividend income I get is 100% tax-free, except for GEO Group. So if you're buying companies over the border where you're going to experience withholding tax, it's very important that you hold them in a tax advantaged account, because that way you're only paying withholding tax and you're not paying income tax on top of it. So to give you a bit of a clarification here, let's presume GEO Group is paying me a 9.6% dividend. I automatically have to minus 15% out for withholding tax, bringing me closer to about an 8% yield, which is actually still pretty nice. But if it wasn't in a tax advantaged account, I would now have to pay out whatever the dividend tax rate was, presuming, let's say it's my regular income tax rate of 20%. I'm losing 35% of that dividend. But because it's in this account, I'm really only paying 15%, which I'm comfortable with because it's a high yielding stock and it's the only one in this entire portfolio. In the same heartbeat, you don't necessarily want to hold your long-term capital gain stocks like Facebook in a tax advantaged account, because you might be getting better advantages holding all your dividend stocks like I do in a tax advantage account over companies like Facebook. So for an example, Facebook, because I'm not exposed to collecting that dividend income while it sits in this account, I will be paying zero tax whatsoever. And to use RioCan as an example again, because I hold RioCan not only in tax advantage accounts, but in my regular accounts, am I going to be stuck paying regular tax on that dividend income? Well, yeah, 100%. But I'm using another loophole to avoid paying tax, because I'm actually using credit to buy this stock. Because as many of you are aware, I'm actually using my line of credit to buy some RioCan. And when those dividends come in, I'm just going to use them to pay back the credit. And that actually defers that dividend income from me paying tax. But in the meantime, I still get to hold the shares in the company. Now, going back to Facebook here, the day I do sell this, which I've already held onto it for probably a good few months, but if by the end of the year, if I decide to sell it, and let's say I'm up 30 or 40%, well, I'm only going to be paying a 15% capital gain rate tax. So you can start kind of seeing it, how this works out in the long run. And personally, I like having all of my dividend stocks in tax advantage accounts, because then I can reinvest them freely without having to worry about how much the government wants. Because if you're holding those dividend stocks in a regular brokerage account, you kind of have to calculate exactly how much the government wants, because if you decide to spend it or reinvest it, you might end up owing a little bit more than you expected on taxes at the end of the year, which is a reminder as well, is if you set up what they call drip enrollment, which essentially means you can actually sign up to companies to pay you out in shares rather than dividends, you have to keep in mind that, yeah, you're getting paid out in shares and you're not getting any cash, but you're still expected to pay tax on those shares that were paid out, which is another thing too many people overlook. So the way I've just saved myself some stress here, just to clarify again, guys, I put all my dividend stocks in tax advantage accounts. I can reinvest the dividends, do whatever the heck I want with that money, never worry about the government chewing down my back. And then I typically hold my growth stocks outside of those tax tax-advantaged accounts. And if I do want to buy dividend stocks, I try and keep them fairly minimal, and then I'll even look for other ways of getting tax advantages in those dividends, like I'm doing with my line of credit here in RioCan. And in light of this, you guys can always come back here every single Friday, so consider subscribing, because that is when I update my stock portfolio, show you guys the changes, things that I'm doing, things that you can learn from. And I'd love to know what you think as well in that comment section below. But stay cool, stay awesome, and I look forward to catching you tomorrow.